Press record, please. Okay, good morning, afternoon or evening, everybody. Thanks ever so much for joining us on today's client webinar. So myself, I'm Graham Bentley. I head up Devere Property, and today we're joined by Rhys Boyle, who's Managing Partner of Global Residential, and Sam Phillip, Global Sales Director of Salboy, the developer. So UK property, pension planning. I run the property part of Devere. Obviously, as you all know, we specialize helping clients create wealth for retirement. And I believe that property is an integral part of pension planning. Diversification is key, but property certainly should be part of everybody's portfolio as far as I'm concerned. Why? Well, we all know that property is doubled every 10 years since stats began. So we understand there's a lot of growth, a lot of money to be made in property, especially if leveraged. If you purchase one property for £250,000 today, generally speaking, that should be worth 1 million in 20 years' time. So imagine buying 1, 2, 3, 5 properties. You can see very quickly how you can create huge wealth for retirement. But the big thing is inflation. And that's a key talking point at the moment in the world. And the great thing when it comes to actually retiring, when it comes to drawing an income for that pension, property is inflation proof. So for instance, if you were to retire at 60, which I think would be nice for all of us, and you live till 80 or 85, the cost of living from when you first retired, okay, to when you're 80 or 85 would have doubled. Now that's sometimes a problem, but where if you have property as part of your portfolio, this section of your pension planning is inflation proof. If you were getting £1,500 a month at the age of 60, by the time you're 80, 85, the likelihood is that would be £3,000 a month. So inflation effectively hasn't eroded away your pension income. You can always charge more year on year. We've seen that inflation has gone through the roof last year, around 5% in the UK. And that's why we saw the average rents go up 7.5%, actually outpace inflation. So really important for us to really have this as an option for our clients. And today we're just going to go into a bit more depth and a new launch to explain the opportunities. So as far as Devere Property, just very, very quickly, I know some of you are already clients and you've already built in a portfolio with us, but what do? We do the research for you. Do you have the time to do that? Probably not. So we look at where in the UK is the best to invest. And then even then, once we find, let's say, the city that we want to invest in, what areas in that city do we think our clients are going to benefit from the most, make the most money from, and get the best rental demand? So we actually go into the micro dynamics of that city also. We work with exclusive partners. As you can see today, Salboy, one of the most prestigious developers in the Northwest, one of the largest. We've got a great track record with them, which we can run into in a bit. But we're very selective who we choose for you as individuals. You may like a city, but if you choose the wrong developer, you could run into problems. So it's very important that we do that research for you first. And then finally, end-to-end service. A lot of our clients, they want to invest in property, they want to build a portfolio, but as expats, you know, if you went to your bank, maybe they would say, we don't lend for expats. A lot of them do. Mine said that. So we make it very, very simple for you. We have a panel of solicitors that specialize in for expats and obviously off-plan properties. We have mortgage brokers that specialize for expat mortgages. We have lettings and management. So really, we can walk you all the way through the process and make this as easy as possible and help you build that portfolio. Okay, so that's enough from me. I'm just going to hand over to Rhys from Global Residential, and he's going to go into why property and where Global Residential think are the best areas in the UK to invest and why. Thanks, Graham.
So as a quick update on why we are so passionate about property and more specifically about the UK, we understand that property, you can get both growth on the asset, i.e. capital appreciation, and you can look at yield. We would certainly look to try and advise clients on a case-by-case scenario, like Graham mentioned, building up to retirement, depending on where you are at, looking at your short, medium and long-term financial goals. hopefully we can use property as that vehicle to really get you to basically a retirement and a better retirement a lot quicker. Today, we are looking at a project in Manchester on behalf of Salboy, very much focused around the capital appreciation play. And that is really about the regeneration that's going on in the area and all of the infrastructure improvements. Secondly, it is a tangible asset. Now, even though clients do like the fact that they can touch it, feel it and physically see it, we still are viewing this unemotionally. We really want to look at the numbers, the investment case that supports it. But the reason I've included that it is a tangible asset is that ultimately banks do like to lend. And if you are leveraging in a growth market, and what I will go to or go through on a couple of slides, is that you can significantly get a high return on your investment by using mortgage finance. And then finally, it is an illiquid asset, meaning unlike an equity where you can simply buy today and sell tomorrow, for me and Global Residential, we feel that this is most certainly a benefit for property, because if we're looking at the likes of Brexit and coming out the back of a pandemic, any kind of political uncertainty, given that it is illiquid, clients aren't necessarily able to come in and out of the market, meaning that we're going to get a true representation of what that asset class looks like. So looking at some stats, this was from the Office of National Statistics. The average house price increased more than £24,500 last year. And that's an average of over 10.8% up to the year or up to the month of December of 2021. So again, real strong house price growth in what many would assume was an uncertain period, not only for the UK, but globally. So with that said, why are we seeing this type of growth? For me, looking at the four main drivers for this, the biggest factor that underpins the UK constantly year on year is that we have an extremely low level of supply coming to the market. And given the factors that we've seen with Brexit and with the pandemic, that has only magnified that. We've had high demand, both from owner occupiers or end users living in the UK, as well as foreign direct investment coming into the market. And that was really stimulated by low interest rates, meaning that you could leverage more, your cash flow on a monthly basis would be a lot more attractive. And banks, again, really stimulating that type of growth. And then finally, what Graham did mention is that even though we are seeing quite a peak in inflation, that has also is also reflected on strong house price growth. So they're the four main factors as to why we are constantly seeing growth, and reflecting back on last year has really pushed the market on. Talking about the supply levels, this is an annual target that the government has set in order to meet the demand. Now, 300,000 units year on year is the target that the government has set. However, that has actually been revised up to 340,000 residential dwellings, as you can see on the left. The target rate is the dotted purple line. However, dating back to 2006, you can see the actual amount of supply that has been delivered. Going up to 2019, just before the pandemic, they were able to achieve around about 240,000 residential homes between 2019 and 2020. So actually on the increase. However, if we were looking back at 2021, that actually then reduced down to 187,000. So again, a huge undersupply in terms of the physical demand. The UK population is close to 70 million people. And if we're looking at the fundamental factors, it is still theoretically a small island, a real finite amount of land to actually build, and the cost of inflation, so the cost of that actual land, meaning developers aren't as active or they don't feel the need to physically build straight away. To support that more, this was a recent Zoopla house price index report, and this talks about 2020 versus 2021, and the demand was up around about 15% versus the previous year. Number of sales were actually up over 12%. However, the flow of new supply coming to the market, i.e. new developments, was down just below 10%. And the stock of homes that are available to sell was down 33.2%. So again, a real supply and demand imbalance. Looking on inflation, as Graham did mention, we are looking at a consumer price index of 5.1%. However, property values do tend to keep up or even outpace inflation. Now, the added benefit that you can get with this is if you are taking mortgage finance, inflation helps erode away the value of your debt / mortgage over a period of time. I'll use a simple analogy in a couple of slides just to explain that in a bit more detail. But what is inflation? Inflation is simply the purchasing power or the amount of goods or service that you can buy with that single unit of currency. So if we were looking at the buying power over a period of time, and this dates back to 1751, if you had £100 sat in the bank, in today's terms in 2020, how much that would actually be in terms of value. To make that more realistic, if we were looking at, let's say, 2011, you had £100 sat in your bank account. Over that 10-year period, fast forward to 2021, with consumer price index at 31%, you'd still have the £100 sat in your bank account. However, it would give you the buying power equivalent of £69 today. However, also in that same time period, the average property increased on average 63%. Now that's not taking into consideration compounded growth, but ultimately that is giving you a 32% gain against inflation. Now that's also not taking into consideration the income. If you physically bought an asset out in cash, you would be seeing a 32% gain against 5.1% inflation. So the benefits of a leverage gain, let's just use an example of a £200,000 property. If you decided to take a 75% mortgage, again, just using these numbers as a simple explanation, that would require a £50,000 cash deposit. Assuming we are seeing a conservative growth rate of 5% over a 10-year period, by year 10, your property would have a value of over £300,000, or to be precise, £300,000 in this case. Meaning that if you was to sell, again, pre-tax, you'd be looking to actually triple your cash. So your £50,000 has actually generated you £100,000 of net profit. Now, going a step further, looking at how inflation erodes away the value of your debt over time. Fast forward to the 10-year period, you now have a property value of £300,000. However, you still have that same mortgage of £150,000. Now, over that period of time, your loan to value was originally 75%. That has actually now fallen down to 50% because you've locked in a rate 10 years ago. Essentially, the purchasing power of the £150,000 has fallen out the duration that you've held the mortgage. I'm going to include a quick cash flow on the project. So for more details on this and the actual availability on the project, we will go into shortly. But just to explain what we can provide for clients. So this is Victoria House, the new development that we have. Now to the top left, we are looking at, as an example, a one-bedroom apartment, £230,000. Now, assuming we would be looking at a 70% mortgage, which is an interest only at a conservative interest rate of 3.5%. The total amount of cash from start to finish you'd need to allocate to this development would be around about £83,900. However, because it is an off-plan project, within about a 4 to 6 week period, you'd be looking at a cash injection of around about £59,000, balance on completion. In column B towards the bottom, you can see the closing costs. So we've again included your stamp duty, furniture packs, mortgage broker fees, etc. Again, being ultra conservative for our clients. Now, assuming that was complete and fully operational, you'd be looking at a net position of £223. So with the income, again, being pretty conservative, you'd be looking to generate £223, which isn't going to make you a millionaire or a billionaire overnight. However, we're really looking at the forecasted growth rate. Now, based on this model, for the next 5 to 10 years, we project a physical return on investment of around about 80% over a 5-year period. If you hold that longer, around about 145%. Again, we are really looking to understand what your short, medium, and long-term goals are, but most certainly in this development, we think the best return on your cash would be to leverage. Prime example of that, now again, dating back to the 1980s, the average purchase price for a property was just over £20,000. To the left, you've got the average house price growth in the UK dating back to 1967. Fast forward to today, in 2022, the average property price is £276,000. So if we are looking at a 5-year projection on a £230,000 property, we most certainly feel comfortable that in 5-10 years' time, we can be looking north of £300,000 very comfortably. But again, adjusting that to inflation, we are still below the 2007 peak. So we do most certainly feel that in the right areas, clients can make money. But back then in 1980, you could have obtained a mortgage for around about £15,000. So if we fast forward to today, if you're looking at mortgage finance for £150,000, £200,000, that is, again, comfortable and normal for investors to take on in terms of debt. One of Graham's favorite quotes, and I think it's quite poignant for this slide, is that the power of leveraging creates greater gains. Essentially, property has made more millionaires and billionaires than all other assets combined. Effectively, purchasing through a mortgage is like a regular savings plan where the tenant is paying for you itself. And some of the largest corporations in the world adopt this model. If you think of McDonald's as an example, the Golden Arches, you might assume that they are just a fast food chain, flipping burgers and making chicken nuggets. But their business model is really identifying global real estate assets. If you think I live in Dubai, next to the Burj Khalifa, there is a McDonald's. In Egypt, next to the pyramids, there's a McDonald's. They would franchise that restaurant out and get the tenant to pay for that asset for them. Meaning in today's terms, they have a global portfolio of over $20 billion. So again, if we can explain this through to retail clients, understand the cash or liquidity that might be sat in your bank not working to its full potential, diversifying and structuring that correctly is what we're looking to try and achieve. So where to invest right now? For anyone who isn't familiar with the UK, again, using a Zoopla house price index, it simplifies where in the UK we are seeing the most growth. Again, if we are looking at the last year, so this is comparing 2021 versus 2020, but Liverpool, Manchester and Nottingham were the top three. Liverpool saw 10.7%, Manchester saw 8.7%. To the right, you have your average purchase price. Now, because today we are looking at a development in Manchester, you're looking at an average property price of just under £200,000. Where if we compare that back down to London, who, again, for anyone who isn't familiar with investing into the UK, might gravitate towards the capital, you're looking at a property price of over £500,000. So for me, I'm thinking, if someone in the UK is thinking about a place where they can afford, to get onto the property ladder in London is fairly difficult. Manchester is most certainly achievable. But ultimately, foreign direct investment coming into the UK, you're able to get larger gross returns in terms of income, and the property price is still very attractive. So there's a number of reasons why we most certainly feel that Manchester has long-term growth potential, but just to highlight areas and how they have performed last year. So with that said, I'm going to pass over to Sam Phillip to explain a bit about Salebuoy, again, why we're so passionate to work with them. And we can cover off some track record, but I'll pass over to Sam to not take his limelight.
Anything but morning or afternoon, everyone. Thanks for that, Reece and Graham. Yeah, just touching on a bit of what we do and who we are. We develop, we fund, and we build homes all the way throughout the UK. We're predominantly based in Manchester, where our head office is. However, we operate in London itself and also in Cornwall as well. We have 3 direct offices, one in Manchester, as I've said, one in Hong Kong and one in Shanghai as well. We're led by 2 gentlemen, Simon Ismail, who is the managing director, and Fred Doan as well. Fred's maybe the more famous face that people will be aware of. He's one of the wealthiest men in the UK. He's a very astute businessman and has great credibility. from there. Our group's made up of 3 parts, and this is crucial to who we are. With us being a self-funded developer, we have our own finance arm called Salboy Build Partner, which we lend just short of £300 million out to other developers, local house builders throughout the UK. But a predominant Salboy product and build is because we are the developer and Domus is the contractor. Domus is our own in-house contractor. They also build for competitors of ours, but being self-funded, we've been able to deliver quite a lot over the last 18 months. Coming up there, 2,500 homes over the last 18 months, and that is solely in Manchester alone, and the 6 main developments that we have. I'll only talk about a couple of them, and the 2 most famous ones that if you guys have been clients of De Beer for a long time is Local Crescent down at the bottom and Local Blackfriars up on the left. Blackfriars was 383 apartments, a 5-minute walk from Deansgate and the Arndale Centre, and where I'm actually sat at the moment is in our Local Crescent development, which holds our sales office. That was 399 apartments, very much a 5-star hotel luxury amenity vibe, and Blackfriars is more of a kind of Soho house living. So everything's fully occupied as well. We're very, very proud of that. Obviously, the guys at Global Residential are a historic relationship. They look after clients on our behalf as well, and obviously through you guys and a partner at De Beer. So we're very, very proud of the fact that everything's fully occupied. We've got a sterling reputation throughout the city, and purely based on our deliverability, but more importantly, our build quality and being able to spot the right areas. I know Reece is going to touch on the new project, which I can have a hand in as well if need be, but the big thing for us is its quality. It's all about the location, and it's making sure we've got the prominent building in that location. So everything else that is regenerated comes either after that.
Just on that, Sam, because look, the Crescent is quite a large development itself, and given that it's fully occupied is really a credit to Salboy and what you do deliver to. I know you mentioned about the increase on rents, but
yeah,
with that being the most recent project that completed, can you just highlight in terms of the rental demand and some of the feedback from tenants?
Yeah, absolutely. Look, we're financiers to trade, so that's how we fund. So we always err on the side of caution. So obviously with yields and cash flows and calculations, we always like to under promise and over deliver. We'd estimated when we first launched Local Crescent that 1-bedrooms would be getting between £850 and £900 a month. Fast forward 2 years later, you're now talking between £1,200 and £1,300 for a 1-bedroom. Now that goes back to the supply and demand thing. It's not just in terms of what's being built, but also in terms of people who can afford to buy in the city. And the key thing is with the high-end amenities, the kind of Soho house vibes, these sort of things. This is what a modern day tenant expects, not wants anymore. It's an expectation. You've got sub 40-year-old tenant demographic who want everything at the touch of a button, and to have that kind of hotel relaxed, easy living lifestyle. So we've been very proud of the fact of that. It's not only driven prices up, obviously, to purchase, but also the rentals for you guys as investors is second to none.
Yeah, I think that just to kind of go on a bit more about the quality that you guys finish to, these pictures really should kind of incorporate everything on what we're trying to explain to clients, given that 5-star finish. But I'll let you talk through the Crescent just in a bit of brief detail, because again, this is part of the communal space on the bottom and co-working space. But I think that's been a huge success, right?
Yeah, absolutely. And look, not saying that we foreseen what happened, anything but we were quite lucky in a way that we wanted to build these big amenity spaces and these community spaces for tenants for co-living. But obviously with the pandemic, it kind of played into the hands a little bit because more people went towards these sort of schemes, because we also incorporate outdoor space, roof terraces. these sort of things. That's obviously at local Blackfriars. Now, having all those amenities on your doorstep when it's a managed block, obviously they opened a little bit quicker than the rest of the world, but naturally people can get out their house, they can go for their walk at the time. So we've incorporated that over and over again. The quality though that you touched on, that's testament to Domus, as I say, our construction company. With us being a developer contractor, we're able to keep everything in-house, which means that we can build a higher level of spec but not charge as big a price per square foot. And again, that's why people come back time and time again. And using Graham as a prime example at De Vere, we've worked together for 4 or 5 years now, and I know he's had clients that have bought in one development, then a couple of years later bought again, and then it's more the deliverability and the quality of work as well. And yeah, we're proud to win an award of the Bespoke and Urban Developer of 2021 last year.
And I think that is important, because I will touch on Victoria House and the new launch, but for clients having the ability to get into a project at an early point, and if we are looking at an off-plan project, given your track record and the credentials that you have, for anyone whose first investment into the UK, knowing that you deliver on time and to a high standard, we're very confident to put this out to people starting off in the property sector and trying to get onto the property ladder. So thank you, Sam. We'll cover off on the project shortly. But just as a quick overview on why Manchester, and the word Salboy actually derives from the word Salford boy, or I've probably not said Salford correctly, or not from a Mancunian. But in terms of Manchester property highlights, this was an article taken from the Times, and the quote was around, or the article was around the 2 young working professionals who were freelancers who were considering buying in London. And they quoted, everyone under 30 is moving to Manchester. They were looking at a 1-bedroom apartment of just over £500,000. And they actually went on to buy a high floor 1-bedroom apartment in Manchester for just over £300,000. I think it was £360,000. But they go on to talk about the quality of living, most certainly in their development that they bought, being able to have state-of-the-art facilities and amenities, which should be compromising back down in the capital, and the real kind of buzz around the city. So I wanted to include that in terms of local sentiment from people living in the area. More than 80 FTSE 100 companies are based in Manchester, and that has been a strong increase since 2016. So we're seeing large corporations shift and move to the second largest city. Media City has a £1 billion to double its size. So again, government backing to keep regenerating and basically adding value to the city. If we are looking at a 5-year forecast, this was taken from Savills Q4 UK research report. In a 5-year projection, they anticipate conservatively 24.1% growth. Given what we saw last year, they are pretty conservative, but that's what we can expect in a 5-year period. Urban Bubble, so they're a large lettings and management company based in Manchester. They quoted that residential developments are nearing 100% occupancy. So this was from their Q3 report released in December of last year. And in September, there were only 427 apartments available to rent, which was actually 79% below the year before. This then talks about a 5-year rental trend. So even though we have seen gradual increase from 2016 up to 2021, we saw a real peak on August back of last year. I think coming out the back of a pandemic, you can see clearly from the 2 and 3 beds, there's been a huge spike. That tenants aren't necessarily focusing on, okay, let me just buy in a certain location. They want better quality of living and they're happy to get larger space. But again, a real kind of pickup across 1, 2 and 3 beds. So with that said, these are the details for our new launch, Victoria House. And as far as global residential are concerned, we really look to identify the best areas for long-term growth. Now that really comes around the regeneration and where this project is located. So Victoria House to the top right of this image is literally a stone's throw away from Portugal Street East regeneration program. In terms of location, you are literally a 30-second walk to Manchester Piccadilly train station, which is part of the National Rail and Manchester's main train station. However, in terms of infrastructure improvements, it is going to be part of the HS2. Now, more importantly, in terms of a short to medium term regeneration program, to the bottom of this image, you have Mayfield Park. Now, Mayfield Park is going to be Manchester's first park that is going to be delivered in over 100 years, which may not seem like much, but for everyone living in the city, being able to go out and go into real nice communal areas and again, kind of socialize with friends and family, again, will really retain tenants that are actually in that area. However, by 2024, there are due to be, I'll fast forward, 2 Grade A commercial blocks. So it's 1.6 million square feet of Grade A office space. Now, Victoria House is off plan. It will complete in Q2 of 2024. So for us, looking at the investment case and profile of tenant that's coming to this area, it's pretty huge. This is both private and government backed. The government have allocated £23 million to regenerate this park. Now, it is a 12-year master plan, but again, looking at the actual staged completions with the commercial space and office space coming online right in time when Victoria House completes, that was pretty key for me. But work is underway and progressing. I'll let Sam add in just in terms of the location, but for anyone who doesn't know Manchester, the Grey Ring Road would be classified as city centre. Victoria House is to the right, literally 30-second walk away from Manchester Piccadilly. But Sam, if you'd like to give a bit of an overview on the city itself.
Yeah, absolutely. So the city geographically, as Rhys just alluded to, sits within the ring road. From there, we predominantly have built in the centre and to the east of the city, the west of the city as you see it from there. So the 3 main parts that I want to show you is obviously Piccadilly Station, which is obviously a 1-minute walk from Victoria House. The reason we've identified that is that part of the city has been regenerated from the outside in. Now, what I mean by that is the Northern Quarter, Ancoats and New Islington that you can see are the 3 trendiest places to be in Manchester. So they're very much the kind of Shoreditch type to compare to London. Now, Ancoats itself was voted the 13th greatest region to stay in, and that's in the world apparently. So that's pretty good from there. Now, the city centre itself, there's 2 bookends of the city. You've got the Arndale, which is the famous shopping centre, and then you've got obviously Deansgate, which is the commercial street that runs all the way along. Number 5 on that chart is Spinningfields. That's the CBD. That's where all your big banking area is. All of this is a 10-minute walk. That's the thing. Manchester geographically, you can get pretty much everywhere walking within 10-15 minutes. The reason we've identified Victoria House is because it's part of the Piccadilly Central regeneration, as Rhys touched on, because of its close proximity to Manchester Piccadilly, but more the fact it's going to be one of the first residential developments there. It's going to be nice, it's going to be tall, it's going to be lovely, as Rhys will show you in a second, but it's the tenant profile. With Mayfield Park being there on the doorstep, that's how we identify it. What we do is we look at it forward in advance, because we're all investors ourselves, and we look at it and go, right, it's very easy to get a tenant in Manchester. How do you keep them, and where does the flow come from? And again, using London as a prime example, the Middle East, Hong Kong, wherever you are, the majority of the young sub 40 clientele and tenant profile will want to be in the city, so they've got easy access for everything.
Great. So this is an off-plan project. It launched just over a week ago. However, in total, we're looking at 177 1, 2 and 3 bedroom apartments. We are, with certain aspects, looking at uninterrupted views, either back down towards the city centre or in the opposite direction towards New Islington and Ancoats for a bit more of a greener view. But having the opportunity to get in at an early stage will allow you to really kind of select, i.e. from preference, a particular aspect. Again, in terms of the actual location, for what we're seeing, as Sam mentioned, a real lack of new build, high quality residential developments located next to it, which I will touch on the next slide. There is a 5-star hotel called the Leonardo Hotel, which even before it's actually complete, it's in construction now, has already won awards. So that's the type of profile of tenant that we're expecting for this particular area. A quick snapshot on the availability. Now, this has been launched just over a week. The uptake from existing De Vere clients has been pretty strong, i.e. looking to pre-reserve and secure units. But prices do start from £191,000, but due to aspect size, please do speak with your advisor on particular developments or particular apartments. What I did want to highlight is that we have put as a conservative yield figure 5%. When looking at cash flows and to manage clients' expectations, because De Vere are a financial advisory, we want to, as Sam mentioned, under promise and over deliver. So again, for more details on the particular units, please do speak to your advisor. In terms of what to expect, this is going to be a real kind of Sowboy-esque type finish. So modern, contemporary, again, all white goods included, but very spacious. The floor plans have been very much thought out. Some of the 2 beds have dual aspects. So again, please do speak to your advisor for more details. On the 2nd floor, there is a Soho House private club style facility. Again, Sam, he can probably echo what I'm saying. Due to the success that Sowboy have had in their previous projects, they're literally looking to replicate that in the right areas. So again, private terrace on the 2nd floor, 24/7 concierge service, and there is then a gym on the 1st floor. This will be some of the computer-generated images of the gym. But due to the success that we've seen from previous projects, we think location and the investment case of Manchester for any clients looking to buy into their first property in the UK, I think this would be a great starting point. Sam, is there anything more you'd like to add about the development itself?
Yeah, it was more about our kind of philosophy and aspect. The reason, obviously, that obviously I'm on the call is testament to obviously my relationship with Global and Graham at De Vere, but we predominantly build for the owner-occupier market. So this is why obviously getting in as early as possible is key, because about a year out before the project, we stop investment from the start. What we then do is focus on the owner-occupier end user. That's why we create these amenities, the outdoor space, and the close proximity to the city centres. So I just wanted to kind of hamper on that a little bit more, because obviously what we end up doing as well is we do increase prices throughout the build as well, and that's something that's quite important. And we're quite shocked at how well the take-up's been on this, and obviously you guys in De Vere have had quite a big part in that. But that's something to obviously look at going forward. But no, any questions, obviously you consult and Reece and Luke are obviously our eyes and ears on the ground.
Just quickly, guys. I think there's potentially a price increase. I'm not sure when, but
1st of May.
When? Sorry, Sam.
1st of May.
The 1st of May. Okay, so there's price increases the 1st of May, but obviously, I know a lot of our clients, they sometimes remortgage in property to take equity out to build their portfolio, or sometimes need to liquidate funds from whatever it may be, fixed interest accounts, etc. But as long as that reservation fee, the 5,000 reservation fee and reservation form is in, then obviously those prices are locked in for you. But I mean, what we're seeing, Reece went through the slide there from December, but January, February have been record months as well, and we're seeing the UK increase generally at just over 1% a month at the moment. So naturally, prices are going to increase. But yeah, glad that we've got in early and we've got a great allocation that's exclusive for our clients. Yeah. So, Reece, you want to finish up, or?
Yeah, sorry, we've recorded these slides which we can share. However, we've put on a poll for if you would like more information from your consultants, so please do select that. But yeah, just to let you know that these slides can be shared. But sorry, Graham.
I think anybody that's interested, yeah, please reach out to your consultant. It's very important to go into a bit more depth. Obviously, we don't want this to drag on. It's just giving you a snapshot of the development, but obviously there's many different styles. We need to, you need to look into the floor plans and what fits you, and definitely look into the cash flows to really look at the investment case. So please reach out, and I really appreciate everybody coming on today. Thank you guys for hosting.
Thanks, Graham. Thanks, Sam.
Thanks everyone for coming on. Thank you.
Thank you.